CPA Australia believes New Zealand should introduce a broad-based low capital gains tax. To talk about why, I'm joined by its New Zealand Tax Committee Chair, Angus Ogilvie. So what would be the benefits of some sort of more comprehensive capital gains tax than New Zealand has at the moment?
Well, I think we're really looking at the demographic shifts in the New Zealand population, Brent. So we can see baby boomers in particular are retiring, and that number is going to increase. At the moment, about 50% of our income tax is collected from PAYE, and about another 30% from GST. Quite a small percentage comparatively in company tax and other incidental excise taxes and the like. So we really contend that for a long time we've been in a position where we believe that the New Zealand tax system is broad-based, low rate. There's a very powerful argument to suggest that actually it's not broad-based because it ignores capital taxation largely, although there are some exceptions. And it's questionable whether you would consider it still to be a low-rate regime.
And what I mean, I think looking at Australia and the experience there, if we are going to introduce a more broad-based capital gains tax, what should we avoid in terms of the complications that might come with it?
Well, that's very germane to designing the system. And interesting, the Tax Working Group in New Zealand back in 2019 recommended a CGT, a very comprehensive one. But I'm not sure a great deal of work was done with comparative systems around the world. So it's important that the capital gains tax has equity at its core. Quite how comprehensive that needs to be is a moot point. Having said that, though, there does need to be some consideration around SME business owners. We believe because, and indeed the Tax Working Group conceded that, those with a valuation under, say, $5 million in value, I think it was at the time. Though that's certainly a consideration in the design. And also, of course, I think in order for it to be even remotely politically saleable, you would need to exclude the family home from any CGT regime. Having said that, there is still an opportunity to impose a CGT purely to increase the tax base, and so there's another source of revenue coming into the government. Essentially what we seem to have is structural deficits now going into the foreseeable future. The government simply cannot balance its books, and that's why we believe CGT is a concept whose time has come.
But is it then capital gains tax about raising more money for the government, or could you introduce it and at the same time as that then allows you maybe to cut tax rates, personal income tax rates, for example? Well, or as the IMF it recommends, introduce a capital gains tax and cut the company tax rate.
Yes, indeed, but there's reasonable parity between the New Zealand company tax rate and the Australian one. I think that the stronger motivator would be to give some tax relief to low and middle income earners, and CGT would certainly provide the impetus to do that.
If you exclude the family home, which the previous Tax Working Group recommended too, but is there a danger there though you then encourage people maybe to invest more into the family home as some sort of longer term investment that they can cash up, for retirement?
Certainly some anecdotal evidence with that happening in the Australian environment and in other jurisdictions around the world. You're absolutely right. I'm just not sure we've discovered a mechanism to prevent that sort of behaviour. But nevertheless, I mean, the Tax Working Group, I think the estimates were that this would bring through several $1 billion worth of revenue over a period of time. And that gives the government some policy options. It seems to me that the government has ignored any serious structural reform. and in the absence of that, something's got to give. So it's probably one of those head over heart type decisions, in as much as in the absence of, for instance, increasing the retirement age or making some other structural reforms in the welfare area, then really the only opportunity is to bring in more revenue.
I mean, this has become a very partisan issue here. Really it's sort of almost a right-left split. Does that surprise you? Because I don't think the evidence from overseas is that a debate around capital gains tax has become that kind of, political in that way.
No, and we're an outlier in New Zealand, Brent, too. So I think we're the only OECD member that doesn't have a capital gains tax. We do have capital gains taxation in a limited sense. Obviously, people cannot go and buy a rental property with the purpose of making a capital gain. There's also some capital gains around foreign investment for New Zealand resident taxpayers, but it's long been held to be a bit of a political football. And you're right, I don't think in my living memory any centre-right parties have ever advocated a CGT. But we are quite peculiar. We're an outlier in terms of not taxing capital. The IMF, the OECD, all international bodies seem to recommend it as a course of action. And if the options on the table were a CGT or a wealth tax, I think we'd go for a CGT every day.
And I mean, from that fiscal perspective argument, the sooner it's introduced, the better, because, right, it's going to take, 5 to 10 years before it fully comes into effect?
It's a slow burn, yep, absolutely right. So you don't expect a large dividend from implementing a CGT overnight. And we would think that probably the better way of implementing a CGT would be on a realisation basis, so when an asset's actually sold, and that may be many years in the future.
I mean, the IMF seems to argue too that there would be some, likely productivity gains from having a capital gains tax. Do you see that there are broader economic arguments for a capital gains tax?
Oh, very much so. But obviously, as an accounting organisation, we tend to be more focused on the on some of those taxation fundamentals, particularly around equity, and also the realisation that with the current expenditure from government at the moment, there's simply just not enough runway in terms of revenue.
Well, just picking up on that reference to the fact that you are an accounting body, I know some of the critics who will comment on this will say accountants love this idea because it means more money for them.
Well, it would if you had to value the asset on a regular basis, although arguably it'd probably be more money for valuers. One wonders whether you'd be better off packing your bag, finishing up your accounting practice and going out into valuation. But that's why we say on a realisation basis that's probably the most efficient way to do it. I'm not sure that that's the motivation behind what we're suggesting.
Yeah. So it is possible, though, to have a relatively straightforward capital gains tax. I mean, we don't have to make it overly complicated, right?
That's correct.
What would that look like, though, just very quickly?
Well, obviously, disposal of businesses would need to be part of that, and I'd imagine that would be done on a realisation basis. If one of the principles, I think, for the design of any tax system is efficiency, so it must be an efficient system. So realisation is, it's a third-party transaction. No valuation is required in that exercise. That's precisely what somebody has paid for that asset. Exactly the same for residential rental property, which of course would be caught by this. And there would be no need for the seesawing with policy settings around particularly the Bright Line test and other quasi-CGT type initiatives that have crept into property taxation.
Angus Ogilvie, thank you for your time.
Thank you, Brent.
For more content just like this and all the latest business and political news, head over to mbr.co.nz.